This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey everybody, welcome back to the Human Action Podcast. Today I'm going solo again, and we're going to do another deep dive into the issue of central banking. But what I'm going to do for this episode is read to you an excerpt from Murray Rothbard's The Mystery of Banking, and then I'm going to just explain to you his framework, because I'm realizing, just in seeing discussions on social media, there's even a lot of self-described Austrian school fans who I don't think quite understand just how insidious the central bank is, right? And I realize that's a strong statement since lots of people really can't stand the central bank. But what I mean is what we're going to cover in this particular episode is I'm going to show that in the Rothbardian framework, what the central bank claims to be doing on behalf of the general public vis-a-vis a private, unregulated banking sector is the exact opposite of what it actually does. Okay. And I'm not even talking about the purchasing power of the currency, right? Like a lot of people understand that it's crazy when Fed chairs get up there in front of the cameras and talk about, hey, we're going to do our best to fight inflation here, and we're on your side, and we're taking all these measures when they're the ones who are creating the money that's causing prices to go up, right? That's ridiculous. But that's not what I'm talking about. It's something more fundamental in terms of the inherent market checks on commercial bank credit expansion. All right, so this all ties in the stuff that I've been talking about lately ever since Richard Werner was on Tucker Carlson's show. Before we get into the meat of this episode, though, let me make an announcement. The Mises Institute has another book giveaway. And this time it is a collection. It's called Hayek for the 21st Century. And it's a collection of some of his most famous essays or excerpts from, his longer works. And I think they did a really good job grabbing various samples of Hayek's works, just to give you a good sampler, if you will, of his overall worldview. So there's things there, like an excerpt from The Road to Serfdom called Why the Worst Get on Top, that for a lot of people, that's really what they took away from that book. There's also one of Hayek's most important economic, peer-reviewed journal articles called The Use of Knowledge in Society. Just a little anecdote, that particular essay, when I was a grad student at NYU, every week we would have what was called the Austrian colloquium. And, so we're all people in my cohort going through NYU are getting our PhDs in economics, and it's a very technical program. And then I'm doing this thing every Monday going to this Austrian colloquium, and some of my, classmates are asking me, what is that? And so for some of them, I said, well, if you really want to know, and I had them read the single selection that I picked for other trained economists to get them to understand what the heck is this Austrian school about. In this case, I chose Hayek's The Use of Knowledge in Society. For what it's worth, it was the two Japanese students asked me, and I gave it to them, and they came back and they said, I didn't understand it. It may have been partly a language barrier because their English was not great. Their English was way better than my Japanese. I always reassure them. But in any event, my point being that to those who are familiar with Austrian economics, some of the stuff Hayek writes in that particular journal article, it's like you think it's obvious or whatever, but I can't express to you just what a fresh perspective that was for the mainstream economics profession, and that he was, getting that in a good journal, just kind of showed his academic pedigree. So, as I say, this new book from the Mises Institute, Hayek for the 21st Century, has a collection of various items just covering the broad body of work that he produced. And it's free, right? So if you go to Mises.org/Hayek21, right? So Hayek and then 21, you can just fill out your information. If you're in the United States, not only is the book free, but they'll even cover the shipping. If you're foreign, they won't charge you for the book, but they will charge you for the shipping. And also, let me just mention, it's not just your personal copy. If you can put in the form how many copies you want and, fill out in the explanation what you're going to use it for. And if you, are part of a homeschooling group and they cover economics or even basically any kind of thing touching on society, really, and you think that book would be appropriate, you can go ahead and request copies for the kids. You can give it to your local, whatever, Chamber of Commerce meeting, just whatever you want. Give it to your church. Go ahead, knock yourself out. Just go ahead and go to Mises.org/Hayek21 and fill in your information, and they will get that out to you within 1 to 2 weeks. Okay, so again, what we're talking about tonight is Murray Rothbard's view of central banking, and here I'm drawing on his magisterial work, The Mystery of Banking. So if you're watching the video version, this will be flashing up some screenshots here. And in particular, well, let me just mention, as they explain in the preface, or maybe it's the forward, I always get those mixed up, to this particular volume that the Mises Institute put out, this was, in some sense, a neglected classic from Rothbard, that there were various hiccups in the publication when it first came out, and it just, a lot of people overlooked it. But then when you go and look at it, it's amazing. And so they put it out right around the financial crisis, to reissue it, to make sure that this, in PDF form for sure, could get into the hands of the people who needed to see it. And Rothbard, just in his characteristic fashion, just goes through and step by step, he first lays out kind of like the theory of money and banking, and then does a history lesson focusing on the United States and the origin of the Federal Reserve and so forth. And one of the things that I know I took away from this when I first read it was understanding the sense in which the notion of a central bank. So not just being skeptical of the particulars of like how the Federal Reserve was formed and looking at, oh, wow, they went down to Jekyll Island. Yes, that's all important, and it's a fascinating story and so forth. You could tell that around the campfire and scare the little kids. But what Rothbard does in this book is really isolate and lays out step by step how once you understand the operation of a free market in banking, and we'll talk more in this episode about what that means, what's sometimes referred to as free banking, then when you see the mechanisms at play and how standard competition and voluntarism that characterize everyday market transactions, how that protects the public from shady behavior on the part of the bankers, how the very concept of a central bank, so even when a central bank works, quote, as it's supposed to, it actually tears down those protections for the public, right? So that's what I want to just get across to you folks in this particular episode. All right. And what's interesting here, will flash up for those watching the video version of this. If you see on the screen there, this is the table of contents from The Mystery of Banking, or a portion of it. And you can see that section 8 is called Free Banking and the Limits on Bank Credit Inflation. And then the next chapter 9 is Central Banking, Removing the Limits. All right, so there, just in terms of the titles, he's laying out what the argument is, right? So logically speaking, first we have to explain what are the limits of bank credit expansion or inflation in a free banking regime, and then it'll be obvious once you understand the mechanisms by which the public is protected from rampant credit expansion or inflation of the money stock via the private banks in a regime of free banking where contracts are enforced and there's no special privileges. Then, once you understand that as the baseline, then you see how, now throwing a central bank into the mix. And again, not a corrupt central bank, not a central bank that goes too far, but no, a central bank that does what its backers say it's going to do, what its ostensible purpose is. You can see how, that systematically weakens all of these checks on private bank credit inflation that Rothbard just explained in the prior chapter, right? So that's what I really want you to see, to fully appreciate why, especially among, Rothbardians, we really are not fans of the central bank and why, chants of end the Fed spontaneously erupted when Ron Paul went to the podium in his recent 90th birthday party, right? Like, it's not just some kind of quirky thing. that no, there's a reason that Rothbardians really do not like central banking. Okay. So I think maybe before I spell out how the regime of free banking works, let me clarify something. Because this, every time you see people arguing about so-called 100% reserve banking versus fractional reserve banking on social media, people will matter-of-factly say, oh, well, if guys like Murray Rothbard had their way, banking would literally be impossible. Or at the very least, the credit intermediary function of banks, by which banks are sort of the middlemen that channel savings from households into the hands of various borrowers, that's one of the functions that you think the banking system provides. And they will say that's literally impossible if we were foolish enough to follow Murray Rothbard's advice and insist on 100% reserve banking. And that kind of a model, they say, all banks would do is just be a place to store your money, and that's all it would be. Like just you put your currency or your gold coins, if it's an economy that uses gold as the money, on deposit at the bank, and then you can go around and write checks on or whatever, but that's it. Like nobody's able to borrow money from the bank because, we got to keep 100% reserve. And no, that is unequivocally wrong, okay? And I'll spell out in a minute why it's wrong, but let me just back up what I'm saying here by an appeal to authority. I know that's a logical fallacy, but here what I'm trying to do is convince you, the listener, that this isn't, it's not possible that allegation is correct, because it's not just Murray Rothbard and his ragtag band of followers in the corners of academia who advanced this theory, right? Go to Wikipedia and look up the Chicago Plan, right? And that refers to, in the 1930s, seeing what happened with the Great Depression and all the bank runs and everything, and how that made the money supply shrink. Irving Fisher and other Chicago school economists said we should consider a plan of 100% reserve banking to stop, this source of systemic crises in our financial system. All right. More recently, after the 2008 crisis, it again became popular for some economists to think about this stuff. In this iteration, sometimes they would refer to it as narrow banking. Okay, and say, hey, there should be a thing where if depositors really want to know that their money's going to be there, they don't need to earn interest on their checking account. They just got to know it's going to be there. It's going to be liquid. The bank's not going to go take the money and invest it in other stuff. The money's just going to be there. Why don't we have that? They call that narrow banking, and John Cochran is one of the big proponents of that. I don't want to put words in his mouth. I'm not necessarily saying he's 100% for it, no pun intended, for it, but he's saying, why aren't we considering this, right? Like, let's resurrect this. And then I think he even went through the pedigree and showed how over the decades, various economists had advanced versions of this. At one point in his career, Friedrich Hayek advanced this as well. Now, it's more contentious. Did Ludwig von Mises advocate for it? The reason I say it's not as crystal clear is because I think for sure what happened is Mises said anything less than 100% reserve banking spawns the business cycle. But then in other portions of his writing, he does have nice things to say about certain beneficial consequences from banks issuing what he called fiduciary media. For example, that prices quoted in gold ounces didn't have to fall as rapidly as they otherwise would have, as more people wanted to use gold as the money. Okay. So my point is, over the decades, various prominent economists have advocated some version of what we now could call 100% reserve banking. So this isn't some crankish Rothbardian view that only, the people associated with the Mises Institute now hold up. That no, this is a very respectable proposal, whether you think it's right or wrong. And so specifically say, so all these economists over the decade just thought banks should stop being credit intermediaries? No, they didn't. That's not what the proposal is. That's not what it means when you say I'm in favor of 100% reserve banking. People who say that, what they mean is, for a specific type of account, namely a demand deposit, or in colloquial terms, a checking account. So if in your mind, what you're doing is putting your money with the bank for safekeeping purposes and for convenience so that they can hold on to it while you decide when to spend it and where, as opposed to you having to keep it in your wallet or in a safe at your house, that's one type of operation. And so the proposal is for that type of account where the person thinks that money is available upon demand at any moment, I can go ahead and take my money out of the bank and I expect that it will be there for me. Then for those types of accounts, the bank should keep that money in the vault. All right. I mean, obviously, if it's a multi-branch bank, it could be at a central place and they can move it around or whatever, or restock the ATMs, but you get the idea. All right. That the bank can't use those reserves to back up loans to other parties or to make other investments. All right. That money has to be there because that's what function economically it is serving, is people are storing their money at the bank for purposes of safety and or convenience. Okay. Now, if you want to earn interest with money that you hand over to the bank and you're willing to wait, you can still do that under a proposal of 100% reserve banking. It's just that what you would do it through is what's called a time deposit, or think of it as a genuine savings account. Okay, so nowadays, and especially since 2020, the distinction between checking and savings accounts has been obliterated. But it used to be, like when I was a kid, which wasn't that long ago, even though it was longer than for some of you, when you really had a difference in checking and savings at the bank. And yeah, you could move money from one to the other, but the idea was supposed to be the money you put in your savings account, you would just kind of forget about it and it would be there, and you'd put it there for long-term storage, whereas your checking was, like when I get my paycheck, I put it in there because I know I'm going to need to use it over the next 2 weeks to pay for groceries and to pay the electric bill, and that's just, again, that's kind of the stockpile where you're storing your money as you get ready to spend it in the near future, right? That's what the checking account is for. Whereas the saving account was, as the name suggests, that's where you're saving your money and you're putting it away for the distant future, or at least the medium-term future, okay? And then far more rigorously, you could say banks can still operate as credit intermediaries. They can still be middlemen and women in between the household savers and the people buying mortgage, or needing a mortgage, or a business that needs a loan, and so forth. Somebody's going to go buy a boat. Somebody wants to buy a car and they want financing. The bank can still be the in-between entity that pools all of the savings of the households and the community, businesses that have a surplus and they want to lend some of those funds out, that they can give it to the bank. The bank can pool those funds, pays interest to the lenders, and then the bank's personnel are the ones who evaluate the creditworthiness of the various applicants for loans and then doles out the loanable funds that way, charging interest rates accordingly. And yes, some loans are going to default, but if the bank does a good job of assessing credit risk and so forth, then there's enough aggregate interest earned on the loans portfolio of the bank to be able to pay the people who lent the bank money. All right. A lot of people would call them depositors, but I'm deliberately not calling them depositors because I'm trying to get you to stop thinking like that. Right. Okay. So banks can still do that. And in particular, they can sell CDs, certificates of deposit. That's got the word deposit built into it. Right. So if the bank, you give $950 to the bank and it gives you this legally binding document that says in 1 year's time, you present this to the bank and it owes you $1,000. So that's how you get your built-in interest return. And then they take your $950 and they go lend it to somebody else, right? That's not fractional reserve banking. You can't go to the store and buy groceries with a bank CD the way you can go to the store and buy groceries with the bank's liability as expressed in your checking account balance. All right, so I touched on a lot, or didn't touch on it. I walked through very laboriously the accounting of all this in a prior episode here of the Human Action Podcast. So I'll link to that in case you haven't seen that episode, where I really go through step by step what the bank's balance sheet looks like at each stage, if you really want to understand and put your finger on what is so special about private banks, the way our system works right now, and how is it that by granting loans, they can, quote, create money. All right. And so to be clear, that's only possible because of what a Rothbardian would describe as fractional reserve banking. Richard Werner, when he was on Tucker Carlson, he said the fractional reserve model was obsolete, or was never true, but now has been demonstrated to be false. And he advanced what he called a credit creation theory. I think we're somewhat arguing over semantics. That I don't disagree with what he's looking at. The proponents of the modern fractional reserve banking theory are just worried about other considerations that I think his approach ignores. But either way, both camps agree that there is a sense in which banks right now, private banks, not just the Fed, not just the ECB or the Bank of Japan, but regular commercial banks, when they grant somebody a loan, there's a sense in which they're creating money. And Werner calls that fraud. Rothbard calls it fraud. And it's destabilizing too, I would argue. Right? It's not just that it's wrong, but it also leads to bad consequences. So that's what the 100% reservists are opposed to. So again, just let me say it one last time and then I'll move on to the main topic for today. But I really want to stress this to make sure people get it. Because again, every time I see this argued on social media, at some point someone will make this allegation that, well, geez, if we follow the 100% reservists, then banks can't work. And again, that's not true. Banks can pool savings from the savers, households that live below their means. People get incomes of a certain amount. They only consume a lower amount. So they're frugal. They save some of their income. And then they don't want to be directly granting mortgages to people. That's too risky. So instead they give their savings to the bank, which then lends it out to others. That's all fine. It's just you can't do it via checking accounts. And so long as you don't do it through checking accounts, so long as you do it like through CDs or other instruments where the savers that are handing over their savings to the bankers genuinely renounce command of that money for a certain time period, then there's no money being created by what the banks do when they lend that out. It's just a pass-through. All right. If you give $950 in currency to the Bank of America, and they give you a CD, a certificate of deposit, this is in 1 year time, you present this and we'll give you $1,000 in currency, you have transferred $950 to them and they can go lend that out to somebody. All right. The money supply did not go up by $950. You have an asset. You could say right now at the moment of the sale, the market value of your CD is $950, but that's not the same thing as saying you have $950 in money. You don't. You used your money to acquire a different type of financial asset, right? You can't go buy stuff with your Bank of America CD. In contrast, if you take $950 in green pieces of paper, go to a bank teller, hand it over and say, I want to deposit this in my checking account. And then they give you the receipt and you see your checking account balance just went up by $950. And then the bank now, because it has more reserves, feels comfortable granting more loans. Well, those new loans they granted, that increased the money supply because you still think you have that $950 available to spend, right? So that's the fundamental difference here. And so again, that is what the 100% reservists are saying. should not be allowed. And also Rothbard would argue in a genuine free market, with a libertarian court system, it wouldn't be allowed. It's just like that. It's and market forces would drive that practice to oblivion, or at least to really minimize it. All right, so it's not that all Rothbardians are saying, oh, we want the federal regulators to come down and impose 100% reserves or else throw people in jail. That's not really, maybe some think that, but no, that's not entailed by the position. What Rothbard is arguing is that in a free market, just standard principles of contract enforcement and then how the market would work, the forces of competition would greatly restrict the ability of any given private bank from being able to lower its reserve ratio without getting spanked by market forces. Okay. Just like a silly analogy, just so you understand that what I'm trying to get across here. You could say, oh, in a free market, I would never expect that restaurants would slap customers when they walked in the door, and then when they sit down would come and dump hot soup on them, and then would swear at them and so forth. And you would list all kinds of stuff. And you say, oh, because you're saying in a free market, like the libertarian judges would know that those are all crimes and that restaurants can't behave in that way. And he's like, well, maybe, depending on the hot soup, like did it leave a second degree burn or something? Maybe that would be actually something that, an actionable offense, but that you could seek, restitution in the courts with or over. But putting all that aside, that's kind of a moot point. It's just, any restaurant that operated like that would go out of business. And so the problem would be quickly taken care of that way at the very least, regardless of the legality of those actions or that behavior, right, by the restaurant staff. So again, likewise, when it comes to 100% reserve banking, Rothbard thinks that once you understand how a genuinely free market in banking would operate, a system of true free banking, then he thinks, this notion of very low reserve ratios is crazy. Okay, so let me go ahead now that I've kind of sketched the outline of what it is I'm trying to get across. Let me just walk you through some of the particulars. Just making a note to make sure I fulfill my promise to put links in the show notes page for some of those earlier discussions about the bookkeeping and such. Okay, so what Rothbard lays out in that first chapter, specifically chapter 8, free banking and the limits on bank credit inflation, is he says that, I think maybe it's easiest to imagine you're in an original equilibrium. Let's say there's like 10 major commercial banks in the community or the economy, if you want to think of it that way. All right. And each bank has some market share, by which I mean some of the public, they bank primarily at a particular bank. People could have multiple checking accounts at different banks, but in general, most people bank at one particular bank, right? And even businesses that might have large accounts, unless you're a gigantic corporation, but even, mid-size and smaller businesses, they probably just have their business checking account at one bank, right? So let's just assume for the sake of argument that each bank has 10% market share. Okay, nothing's going to be affected in the argument if you disagree with, if we change the scenario, but just to keep things simple, right? So each bank has 10% of the market share. And let's suppose originally all the banks practice 100% reserve banking, on their checking accounts. Further, just for me, I think it's just easier to keep things distinct if we do it this way. Again, the argument doesn't depend on this, but when you're first hearing these ideas spelled out, for what it's worth, I just think it's easier to keep stuff straight. Assume the underlying money of the economy in this community are gold coins, right? That's what you might call the base money, the primitive, the bedrock foundation. So prices are quoted in, let's say there's ounces, right? So the standard money is a gold coin that's 1 ounce. And you can either have it be private sector created or the government can create it. It doesn't really affect the argument in terms of the banking, right? That private mints historically existed. People would go find gold, raw gold. Gold rushes, miners would go out and find it. People would be prospecting, get it. You would bring raw chunks of yellow metal in, and people at the private mints, and they would stamp them into coins. Okay, so that's a possibility, just to keep in mind. You don't need the government involved even in money production, okay? But it doesn't really affect the argument whether it's the private mints or if you think the government isn't, it has the job of taking the gold and stamping it into 1 ounce gold coins and puts, official legal tender on it, whatever. Okay, so that's the base money. Stores quote prices in terms of ounces of gold. That's how people get paid wages and so on. Now, in that world, 100% reserve banks could function. In banks, people could take their gold coins into a bank, a private commercial bank, give the gold coins over, and then the banker could somehow let the person leave with some type of mechanism by which he could tell the community, this is how much I have on deposit with that bank, and I have the ability to easily transfer my claim on the bank to you. Okay, so one way to do that we're familiar with is electronic checking account, where you have a plastic card that you can swipe, and that gives the relevant information, and particularly then if you know what your PIN is, to validate it, just to minimize the chance that someone just pickpocketed you when they stole your bank card. And then what's happening under the hood there is, you went to Bank of America, you gave them 100 gold coins. So now you're walking around town. I have 100 ounces of gold on deposit with Bank of America. I take my card. I want to buy something that's 8 ounces of gold. I take my card and I swipe it through your machine. And then ultimately it's the bank's computers are talking to the merchant's computers. And Bank of America says, all right, yes, this person has 8 ounces of gold on deposit with us. He has more, but yep, he can cover that. So we'll go ahead and we will deduct 8 ounces of gold from his balance with us, and we owe you 8 ounces of gold now. So if the merchant already is a customer of Bank of America, that's really straightforward. Bank of America just adds 8 ounces of gold to that store's checking account balance and subtracts 8 from the customers, right? So Bank of America on its end is just changing the numbers on its books internally. Okay, so that's pretty straightforward. But now what happens if the merchant is not a Bank of America customer, right? So remember we said originally, imagine there's 10 banks that each have 10% of the market share. So, the one guy, the customer, is one of the 10% of the community that banks with Bank of America, but this merchant banks with Wells Fargo. Okay, and so what happens there, again, perfectly straightforward. If there's not a hitch, it's not that, oh, geez, in a system of private banking, you can only shop at places where the merchant's in your network. No, that wouldn't be convenient. The banks all have agreements with each other to facilitate transactions amongst their customers, because that makes it more useful to be a customer of a bank that's part of a network like that, right? If you signed up and had a checking account with a bank that didn't have arrangements, both, contractually, economically, but also in terms of just the hardware and the ability for merchants who are plugged into some rival banks' systems to be able to accept payment from customers of a different bank, then you wouldn't want to open your checking account with that bank, right? You would tend to prefer, other things equal, banks that had relationships with their peers, even though they were competitors, but they would all agree, yeah, this is better for all of us if we have a network like this, where our customers can do transactions with each other, and then we, the banks, just all communicate with each other to stay square, right? So let me just walk you through what does that process look like. Okay, so again, the scenario is the Bank of America customer originally put 100 ounces of gold, the actual metal coins, on deposit with Bank of America. They went and put those coins in the vault. They credited his account with 100 ounces. He's walking around town. He goes to the store. That merchant who owns that store happens to be a customer of Wells Fargo. He swipes his card. He wants to buy something that's 8 ounces of gold, right? So the store's computers are talking to each other or talking to the bank's computer. They interface with Wells Fargo. And so ultimately, the way that transaction gets recorded is Bank of America's, it on its books, it's saying its liability to their customer went from 100 ounces of gold down to 92. But its liability to Wells Fargo went up by 8. I don't know what it was before this transaction, but whatever it was, it went up by 8. Say, oh, now we owe Wells Fargo an extra 8 ounces of gold compared to what we owed them 2 minutes ago. But Bank of America is still the same, right, in terms of its liabilities, because now it owes that customer 8 ounces less. Okay, so it's still the 100 ounce of liability, just looking at, narrowly this customer and his original deposit, and now it just transfers the 8, away from the customer and over to Wells Fargo. And then Wells Fargo, for its part, what happens on its books? It has that increase. Oh, Bank of America, whatever they owed us 2 minutes ago, we have like a running total that we're keeping track of. Now, because of this transaction that just got booked, Bank of America owes us 8 ounces of gold more than they did 2 minutes ago. So you may say, oh, so Wells Fargo just had a windfall, right? No, because the other leg of that transaction is Wells Fargo now on its books says that merchant, whatever his balance was, or his business, if it's a business checking account balance with Wells Fargo was 2 minutes ago, well, now they just added 8 ounces of gold to that too. So Bank of America and Wells Fargo, their overall financial position didn't change. It's just they changed some of the components of their assets and liabilities, right? They were offsetting. The people whose financial position changed were the Bank of America customer and the Wells Fargo customer. The Bank of America customer, his financial position just went down 8 ounces of gold, and the other guys went up. Okay, and there was a transfer of merchandise, right? So there's that. But in terms of the money, okay? So I'm just walking you through the mechanics of that so you can see how it would work. And again, it would be in the interest of Bank of America and Wells Fargo to have agreements with each other to facilitate that and to allow for temporary movements in net liabilities between the two banks, right? It would be okay. So that happens if for whatever reason on a given day, a lot of Bank of America's customers, let's say a lot of them, just for geographical reasons, maybe they all work at a particular place, particular employer, and they all get paid at the same time, on the same day, and then their spending habits are similar, and just for reasons like that, just there's patterns in spending of the people in the community such that, for a few days of the month, it typically happens that Bank of America's customers spend a lot more buying things from Wells Fargo customers than vice versa. And so over the course of that 48-hour stretch, there's a lot of incoming transactions where money is being electronically spent that Bank of America owes Wells Fargo more and more money. So that balance just keeps going up and up. And then, the Wells Fargo people their checking account balances with Wells Fargo keeps going up too, because they're the ones selling all this stuff to the Bank of America customers, and they're drawing down, their checking accounts, waiting for the next payday to come. Okay, so that's fine. And Wells Fargo would be okay with that. But the point is, they wouldn't just let that balance just grow indefinitely and just have it be that Bank of America just continually, every week in, week out, has its customers spending more on Wells Fargo customers than vice versa, such that Bank of America just over time keeps owing more and more to Wells Fargo. Among other things, Wells Fargo couldn't just let that roll indefinitely because it owes more and more to its own clients, right? The people who bank at Wells Fargo, who are, as a group in the aggregate, the net beneficiaries or recipients of all this spending from the Bank of America clientele, they think that their checking account balances keep going higher and higher, right? And so if they want to go and withdraw some of that and, say, hey, it says right here, I've got 220 ounces of gold on deposit with you in my Wells Fargo checking account. I'd actually like to draw out 20 of those ounces in the form of gold coins. Wells Fargo has to comply with that. That's what the deal is. That's what it means to have a checking account with them. They say you can show up at any time, and we'll be prepared to redeem your electronic deposits with us in gold coin upon demand. So they have to have that in the vault and be ready or they have to have enough in the vault such that for what they expect the requests for redemption might be on any given day, that they're going to be fine. And they're going to, want a margin above that too, because their business is ruined. If there's ever a time when somebody shows up who's a Wells Fargo customer and says, yes, I would like to withdraw gold coins as I'm supposed to be able to do, and Wells Fargo says to them, you know what? Sorry, the vault's running a little tight this last week, so can you come back next week? Once word in the community spreads that happened, nobody's going to keep their money at Wells Fargo, and then they're done. Wells Fargo goes out of business because everybody shows up and says, give us our money. Okay? Even if Wells Fargo's loan portfolio was great, that no, we did a good job assessing creditworthiness, that we charged enough in the interest, like for the particularly risky borrowers, we charged enough in the interest rate that we charged them, such that, on average, that pool of risky loans is still, paying an overall average rate of return comparable to our other lines and so forth. Even if they're doing that fine, the loan officers did a great job and everything. If they just kept letting Bank of America's customers spend way more week in and week out vis-a-vis the Wells Fargo's customers, then eventually the Wells Fargo's customers, might drain Wells Fargo's vault. Okay, so that's why Wells Fargo can't just sit back and let that happen. They need to, at some point, tell Bank of America, hey, over the last few weeks, just on net, you keep owing us more and more. And so we're going to need to call that, right? Because that's what it means, right? That's part of the agreement that the banks all entered into on the front end when they joined and formed this network, is they agreed, yes, we will honor, for all of us who are in this network, we will honor each other's transactions at par. That if, for example, if a Wells Fargo customer, I just want to explain to you, what does it mean to say, honor their transactions at par? A Wells Fargo customer who is a merchant, a Bank of America client, I should say, just to keep things distinct so you're not getting confused. A Bank of America client is the customer at this merchant store. The Bank of America client walks in, he wants to buy something that's 8 ounces of gold. Like that's what the sticker price says. So he could just take out 8 gold coins, slap them on the counter, and the merchant could go ahead and sell him the merchandise and say, there's the 8 ounces of gold. It's an expensive piece of merchandise, don't get me wrong. As I'm working through these examples, 8 ounces of gold is a pretty penny. It's a lot more than that. Okay? So that's one way to do the transaction. And then the merchant would just, at the end of the day, or certainly at the end of the week, would take the accumulated gold coins, maybe in an armored vehicle, and go down to the bank and put them into his checking account. So that's one way of doing it. But what if instead the Bank of America client pulls out his debit card, that's a Bank of America debit card, and says, no, let me just swipe this, because I'm not walking around with 8 ounce gold coins on me. That's crazy. Okay, and so in order for the merchant to say, oh yeah, whether you pay me in yellow discs or you pull out a plastic card and swipe it in my little computer thing here, either way, this merchandise that I'm selling to you, I'm just going to charge you 8 ounces of gold. Either way, that's what it means for the merchant to be accepting those two forms of payment at par. And so for the merchant to be willing to do that, it's got to be the case that his bank, in this story, Wells Fargo, treats those deposits as equivalent also, right? So in other words, the merchant is only willing to pass that equivalence through to his own customers if he knows that, oh yeah, when I want to get deposits into my business checking account balance at Wells Fargo, whether I go up to their counter with 8 ounces of gold and lay it on the counter and say, put this into my business checking account, or my computer talked to their computer when the customer swiped his plastic card and said, oh yes, we have an incoming transaction that we validated with the PIN and everything, and we have reason to believe that this person really is the lawful owner, controller of this account at Bank of America, and Bank of America confirms that he has at least 8 ounces of gold on deposit with them, and so they're trying to transfer it to you. Should we go ahead and go through with this transaction? And the Wells Fargo will say, yes, we will also credit our client's account by 8 ounces, just as if he had walked in here with 8 metal discs, because we trust Bank of America. We have an arrangement with them. All right. So because Wells Fargo is willing to treat Bank of America's liabilities, or IOUs, if you want to call it that, as equivalent to gold coins, then so too would the merchant be. All right. So the banks, again, you realize the convenience that that's their model, their business model, right? To get people to use their checking accounts, they need to convince the community that, hey, this has all the advantages of gold coins and none of the downside, right? It's a more convenient way for you to use your gold coins, is give them to us, and then we will give you the ability to transfer effective ownership over these gold coins that sit safely in the vault here with us. Okay? So they need that willingness of most of the community to accept claims on Bank of America as being equivalent to the actual gold coins. All right. So again, why would Wells Fargo agree to that on the front end? It's only because Bank of America would agree, yes, at any time, if you've got claims on us that are piling up, you can ask for those to be, for us to settle with you, to get square. And that if, at the end of the week, if we owe you 618 ounces of gold on net because our customers spent that much more vis-a-vis your customers than vice versa, then we will get an armored car, load up 618 ounces of gold and ship it to you. Then you can put it in your vault, right? Okay, so, whether it's every week or every month or if it's every day, those are kind of irrelevant details, but the concept is there. That for this kind of a system to work, clearly the banks who are in competition with each other are going to insist on some ability through clearinghouse operations to settle up with each other. Okay? So now that I've kind of walked you through that, it's real straightforward to see how does that type of system, so long as there's just standard contract enforcement, and as long as there's open entry, right, that anybody can open up a new bank and set whatever policies they want, how does that type of system contain the ability of any individual bank from inflating, right? So somebody goes in, he puts 100 gold ounces on deposit. The bank puts it in the vault. He's walking around town thinking he's got 100 ounces. What's to stop that bank from making a loan to somebody else of 90 ounces, right? They don't have to take it out of the vault. They can just go ahead and write it up electronically, right? Somebody else walks in, signs a contract saying, I am borrowing 90 ounces of gold from Bank of America at a 6% interest rate, and they go ahead and credit it. And now I walk out of there with 90 ounces of gold electronically in my Bank of America account because I just borrowed that from them. And so in that case, Bank of America now is practicing only 10% reserve, ratio, or obeying a 10% reserve ratio. All right. So, the problem with that, or the danger, is that now, look at what just happened. The Bank of America's clientele now just got an extra shot of 90 ounces of gold without the amount in the vault being increased, the amount of gold coins. And so now Bank of America's customers are able to spend more in the community vis-a-vis the clients of the other banks. Okay? So the idea is, in a free banking system, if any individual bank lowers its reserve ratio below what the other banks are practicing, it has a short-term advantage of that, right? It can advance more loans and earn more interest income on those loans, and that doesn't affect their other clients, right? For the same amount of gold that was sitting in the vault, if on the margin the bank just, quote, magically out of thin air grants credit to some borrower, and now that borrower has to pay interest, so long as the borrower doesn't default but pays the loan back plus the interest, then Bank of America just wins free and clear, right? The other customers are still doing their thing. They still got gold coins in the vault that, maybe getting drawn down or whatever. But as long as that customer can take the loan, go do his thing, and come back and pay the loan off plus the interest, as long as Bank of America can get through that and not go under, they benefited from that operation. They earned that interest income free and clear. And now they can do whatever they want with that. Okay? So you see the benefit to Bank of America. That's why they'd want to do that. And again, every time they advance credit like that, they're effectively lowering their reserve ratio because now there's an outstanding larger stockpile of checking account balances that are backed up by the same number of coins sitting in the vault, right? So every loan that they grant, Bank of America is lowering its reserve ratio. So you see what the incentive for doing that is, what they gain extra interest income. But the downside is if they push it too aggressively, and in particular, if they're doing that more aggressively than their competitors are, who they share the market with, then other things equal, as they keep pushing that, their customers have more and more money at their disposal. And so that means statistically, their clients, when they interact with other members of the community, are going to eventually be interfacing with people who are not Bank of America customers. Okay, so maybe this is a way of seeing the point. If everybody banked at Bank of America, right? If Bank of America had virtually the entire market, it wouldn't matter. There'd be no checks on its credit expansion because granting a loan, quote, out of thin air to some borrower, and now he's got just funds that were magically added to his Bank of America checking account, and he goes and spends it somewhere. If that person he spends it on is also a Bank of America client, Bank of America, there's no drain on its gold reserves in the vault. It just moves numbers around in terms of client balances, right? The real check in a free banking model on the credit expansion of any one bank is not from the public, reading statistics about reserve ratios and going, oh, geez, Bank of America is getting a little too risky for my blood. I'm going to go close down my checking account. That could happen, but that it doesn't need to. The system does not rely on the public's vigilance in order to keep the bankers honest. No, it's the banks themselves competing with each other that keep each other honest in that sense, right? Because again, and it's not some policy shift. It's not that the other banks need to have intelligence agents who are monitoring what the other banks are doing and sneaking in at night and trying to get a look into their vault to see, oh, wow, how many gold coins have they got in there? They don't need to do any of that. It's all automatic. That just if one bank is expanding the stock of money held by its clients by just granting more and more loans gratuitously, to use a phrase, in other words, without more gold coins being put in the vault, but they're just granting more credit ex nihilo. Nothing's stopping them in the moment from doing that, but then that automatically sets up processes where eventually that bank that's expanding more rapidly than its peers is going to keep racking up higher and higher net deficits with its peers, its competitors. And so again, maybe the competitors are content to let that roll for a bit, but eventually they're going to say, yeah, you got to start paying down what you owe us here. Okay. And then that starts draining the gold reserve. So really, the only time that the public would be involved is if somebody goes to the bank that's been very rapid with its expansion and says, yeah, I'm going out of town and I'm going to a country where they might not accept me swiping my debit card with you. So I want to load up on some physical gold coins for that trip. And then they say, oh yeah, sorry, we don't have it. Like that's when the public starts to get alarmed and could be a problem. But again, before that point, the actual check is that if one bank expands rapidly relative to its peers, it's going to suffer a drain of its reserves from the vault into the vaults of its peers. Okay. So having walked through all that now, Rothbard does anticipate an obvious objection, is to say, okay, so really you haven't shown that banks as a whole can't expand in a free banking system. All you've shown is that one bank can't expand too rapidly relative to its peers. But what if the banks, after all, you admitted, Murphy, the banks are all like in this network, right? That they all communicate with each other and coordinate in that sense. Like they have to have it so that their hardware can talk to each other and whatnot. So if they're already that coordinated in that respect, is it so difficult to imagine that they're going to form a cartel and say, look at guys, we all benefit from more interest income if we lower our reserve ratios. So let's just all inflate in unison. Okay. And what Rothbard points out is, for one thing, even on its own terms, that might be difficult to pull off because the banks aren't all going to be identical in terms of the acumen of their credit officers or their loan officers and so forth, right? So some of the banks are going to be more conservative and savvier than the other ones, and so they're not going to want to all just throw in their lot in one common pot, as it were. But even if they did, still, if it's just a genuine free market and banking is a business just like opening up a pizza shop, all right, where it's not, you fill out some standard paperwork or whatever, and then boom, you go, and it's just a matter of enforcing your contracts. Well, then if the banks all lowered their reserve ratios to 2% and they all inflated a lot and they're making tons of interest income and it's great and there's no net drain because they all did it in unison, well, some upstart could open up a new bank and have a reserve ratio of 50%. And then, his clientele would be small in the beginning, but proportionally they would, over time, be getting more receipts from other bank clients than vice versa. And so that new bank would be slowly at first draining the gold reserves of all of the established cartel banks. Okay. And they could make a deal and try to bring that bank into the cartel, but there's nothing stopping that from happening over and over again in a free banking system. Okay. So that's the sense in which, Rothbard is going to say, regardless of whether legally 100% reserves is enforced just as a matter of jurisprudence, that, oh yeah, that's what it means when you have a checking account, that it's a bailment contract, if you're familiar with that kind of terminology. Putting all that aside, you can just say through standard market forces, that reserve ratios, there's mechanisms in place that would keep them trending towards 100%. Okay? Maybe not literally 100%, but you can see that there are forces in place that would push that towards 100%, limiting the ability of the banks to engage in credit expansion. Okay. So let me, again, just go reread. Now that I've walked you through that, in Chapter 9, the opening, Rothbard says, remember, Chapter 9's title is Central Banking Removing the Limits. And it says, free banking, then, will inevitably be a regime of hard money and virtually no inflation. Okay, so now that what I just walked you through in this episode, I'm hoping you understand why he's saying that, what he means. In contrast, the essential purpose of central banking is to use government privilege to remove the limitations placed by free banking on monetary and bank credit inflation. Okay, so now that we've so painstakingly walked through the limits on bank credit expansion that exist under a regime of free banking, it's pretty easy for me to explain how does the central bank knock that down. Okay, so first and foremost, most obviously, what is the original rationale of a central bank? What function was it supposed to serve? You might think, oh, is it supposed to promote high employment and stable prices? I think that's what the Fed, that so-called dual mandate for the Fed is what they told it to do when they revised the authorizing legislation in the 1970s after Nixon went off the gold standard. No, originally, if you go read like the op-eds and things that the bankers would write in the popular press trying to agitate and drum up public support for a central bank in the years leading up to the 1913 passage of the Federal Reserve Act. No, the central claim was that you needed the central bank to have an elastic currency and to act as a, quote, lender of last resort. And so the idea was like, oh, in the 1907 financial panic, when a bunch of financial institutions, including private banks, got into trouble and had a liquidity crunch, they all had to go hat in hand to guys like J.P. Morgan and ask for short-term financing. And then he got to pick winners and losers and decide who went under and who stayed afloat. And we don't want that kind of power in the hands of some man. Let's put that in the hands of public-minded officials that, you know, there's democratic governance and blah, blah, blah. Right? And so the central bank is going to be a lender of last resort, that when the private sources of financing and temporary liquidity aren't there, you go to the central bank. Okay, so that sounds great, right? But think of what type of entity the central bank is going to be a lender of last resort to. Well, it's a private bank that's experiencing a drain on its reserves, even though its loan portfolio might be sound, right? In other words, exactly the kind of bank that we just walked through in the last half hour, showing, oh, if you had a regime of free banking and one individual bank is being more aggressive than its peers and it lowers its reserve ratio by granting more loans, well, again, they need the loans, enough of them to pay back, right? So the bankers aren't just handing out money to harebrained lunatics who have crazy, wild-eyed schemes. No, they're trying to give loans to people that they think will pay back, or again, like I say, that they're charging a high enough interest rate that they think the pool of such loans in the aggregate will give us the same kind of return as, you know, something that was more tailored to more credit-worthy borrowers. Okay, so when a bank gets into trouble in that model, or that system, it's not because they made bad investments and that there was like a crash in real estate or something. That no, even if the economy's doing fine, if that bank was just too aggressive though and lowered its reserve ratio, then again, through what's called like the law of reflux, that they start piling up obligations to their rival banks. And so they are perhaps solvent, right? Their assets might be higher than their liabilities in terms of just looking at their balance sheet. Like, oh yeah, these loans are still performing. It's just, in a sense, they borrowed short and lent long, right? People put in deposits that were immediately callable, demand deposits. That's what a checking account is a demand deposit. And then they went out and granted 30-year mortgages and other long-term investments funded them. Okay, so a bank that gets into trouble because its reserve ratio is too low, it's not that they necessarily made bad investments or that the economy tanked. It's just they have a liquidity crunch. So the issue is liquidity, not solvency. And so a central bank that's going to be a lender of last resort, what do? They come into the rescue. And especially if there's a, quote, elastic currency, and that central bank is able to print notes that are legally equivalent to gold coins, right? Because that's an important thing. In the free banking system, a pure one that's just laissez-faire, the bank's obligations, Bank of America's promise that I owe you 100 ounces of gold is not the same thing as 100 gold coins in the vault. In many cases, it might be treated at par with them, but everyone understands, no, a gold coin is a different thing than Bank of America saying, we owe you 1 gold coin when you ask for it. Those are different things. But depending on the legislation, but in the theory of central banking proper, the central bank's obligations are the base money, right? Like right now, what's in your wallet? Federal Reserve notes. A $10 bill is a Federal Reserve note. In our system right now, to say the Federal Reserve owes you money is the same thing as saying you have money. That's what the money is. It's a Federal Reserve obligation. Okay? So you see that fundamental shift there. And so my point is, if the central bank is acting as a lender of last resort, you can see clearly, again, not attributing malice to anybody, just if they're doing what their mandate is, they are rescuing precisely those types of banks that in the free banking regime analysis we showed, there's limits to credit expansion by any one bank, because it would find itself in a position where, it may have made sound loans, but the timing is off. There's a maturity mismatch. And so having a lender of last resort means, that doesn't spell our doom. If our gold reserves are getting too low, we can just go to the central bank and say, hey, can we have a short-term loan of gold, please? And we'll pay it back in 3 months. And so that's what's going to get them through the crisis. Okay, so there's that element. And then last thing I'll say here, and we'll conclude, what's the other main check? Remember we said, any one bank expands too rapidly relative to its peers, they get spanked in a free banking regime. The other main check was, what if the banks all form a cartel and they expand in unison, or they inflate in unison, keeping roughly the same reserve requirements vis-a-vis each other, so that the net claims all cancel out and, there's not gold being moved from one vault to the other. And there we said, the ultimate check is that, for one thing, the banks might have different standards, and so they might not all agree with each other. And so there's that element that makes forming a cartel difficult. But then the other problem is in a system, of open entry, laissez-faire, you can't stop somebody else from just opening up a new bank. And they could set a reserve ratio higher than what the cartel had all agreed to. And then that bank's going to siphon away your gold reserves over time. And they can't stop that. Even if they bring that one in, somebody else could start a new one, right? Well, not if the banking sector is highly regulated by the authorities, including the central bank, who say, no, to open a bank, that's a long process. You got to put up a bunch of capital. You got to fill out a bunch of paperwork. You got to do this. You got to do that. It's not like opening up a pizza shop. This is a bank. This is serious. This is important for our nation's financial integrity. So no, it's hard to open up a new bank. You can't just have anybody opening up a bank. What kind of wildcat, crazy, laissez-faire system would that be? Think of how unstable that would be, right? So that's the idea. And then also imposing all sorts of regulations on the banks to have, uniform standards of capital requirements and reserve ratios and things like that, right? So notice everything that you would think textbook a central bank ought to be doing to serve the public's interest, each component of that knocks down all the stuff that we just brought up in the prior discussion of this episode as to here's how a genuine free banking regime would protect the public from credit expansion. And that's why you wouldn't have these wild boom bust cycles if you really just had private sector banking left to the market. That no, when you bring a central bank in, it knocks down all of those protections. And it cartelizes the private commercial banks, keeps out competitors, sets rules so they can all say, all right, nobody's really taking advantage of anyone else. We're all kind of inflating together. And we don't have to worry about some upstart coming in because the central bank, the regulators keep them out. They can't. It's illegal. You can't compete with us. Got to be part of the club. All right. So I'll stop there. I hope I've gotten my point across that in the Rothbardian system, and here he was just elaborating what Mises had done in his works, that the central bank, far from, occasionally overstepping or straying from its mandate and doing things that weren't in the original vision. No, even according to the textbook argument of what a central bank is supposed to do for the public, once you understand how a genuinely free market in banking would work, you see that the central bank actually is almost systematically designed to knock out all of those safeguards. And so it shouldn't be any surprise that, even after central banks were established around the world, the global financial sector just keeps having these massive boom-bust cycles, not to mention that the currencies all get wrecked in terms of their purchasing power. Not a coincidence. So if you want to learn more, go read Murray Rothbard's The Mystery of Banking, which, of course, the free PDF is available at Mises.org. Thanks for your attention, everybody. See you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.